Happy Monday. Welcome to After Hours Real Estate. Today, I'm going to be talking about trying to figure out how to get a mortgage with unverifiable income. And we're going to talk a little bit about what that means. We're going to dive into a CNBC article today. Guys, I'm Chris Peshek. I'm a real estate broker just outside of Austin in Dripping Springs, Texas. My buddy who usually joins me today is the mortgage expert here, but Steve's got a couple of things going on with his kiddos for the Christmas holidays. So you are stuck with me today. What we normally do on this show, we jump into all kinds of topics. I mean, heck, last week we were talking about how real estate relates to data centers and AI centers and what that's going to be looking like for electricity production going forward and stuff like that. And we'll talk about buying houses and selling houses. And we talk a little bit about macroeconomics too and what's going on globally that affects all this stuff. But one of the most important things that we do is it's after hours real estate. So we typically have a little bit of a tasty adult beverage. This time of year when I'm drinking, it is a nice Kentucky bourbon or some type of bourbon type of alcoholic beverage. This is an Evan Williams bottled in bond bourbon whiskey. I picked it up on the chance. It was $30 for a half gallon, and it is tasty. So if you haven't had a chance to pick it up, if you are a bourbon fan, they've got it at Twin Liquor in Dripping Springs. I know that for a fact. Cheers. So I want to jump into what this looks like, this unverifiable income, and talk about this. Well, and before I jump into it, let's talk a little bit about what unverifiable income is. Basically, there's no paper trail on it. There's not a paper trail. The easiest explanation for this is, let's say that you work in the service industry, your wait staff or whatever, and you get cash tips, and everybody on this planet knows that you guys that work in that industry, you don't report all of your tips to the IRS. Now, if it's, credit card or whatever, you have to. But if there's cash tips, that stuff doesn't get reported to the IRS. And it's going to be, I think, a little bit easier because Trump is saying, and actually Kamala was saying also, they want to get rid of tax on tips. And I just saw where the governor of Virginia is actually moving forward on this now, and he's getting rid of state income tax on tips as well, or they're going to get rid of state income tax. That's unverifiable income. When you go to get a mortgage, whether it is for a business loan or a mortgage or a construction loan or whatever, you've got to be able to verify your income. They will ask for W-2s. They will ask for, in my case, they'll ask for 1099s. And if you're oh my gosh, I can't even think of what I am, a commission type person, where all of my income comes from commissions. Usually I'm going to try to write off as much of that stuff as possible also, just like the service industry folks. Everybody tries to limit their tax burden within the law, right? And so we do that. So I may take, a $100,000 salary, and I may only pay taxes on $40,000 of it. Well, I'm not going to buy much of a house for $40,000. So this is what we're talking about here. How do you overcome unverifiable income when you're trying to get a mortgage? And I'm going to share the screen with you. I'm going to read through this CNBC article. And by the way, if you've got questions, again, because I'm here by myself today, it's always a little bit tougher. I feel like I talk too fast sometimes, but if you've got questions, please pop in. Or if one of our other mortgage people, Trent, if you're out there and you want to jump in, please jump in. Actually, Trent, if you're out there, tell me. I'll share the link with you and you can jump on as our mortgage expert here because you're going to have insight that I don't have. But please ask questions. Interact with me. It'll slow me down a little bit. It'll allow me a little bit of time to drink some more whiskey. And it'll be more interesting than just people hearing me monologue for, 20 or 25 minutes. But on that note, I'm going to start reading. Again, this is from the personal finance section of CNBC. Unverifiable income can limit your mortgage options. Here's how to get around it. Again, you can understand if you can't verify your income, how are they going to give you money to buy a house or to buy a business or something like that? Key points here. Mortgage lenders want to know if you're financially capable of paying back the loan. They're always, the first thing they're going to do is ask you for documents like tax returns, W-2s, and pay stubs. Any money that you earn that isn't tied to a form like a W-2 can make it difficult for a lender to verify your annual income. This is an economist talking about this. Here's what we need to know. All right, I'm going to enlarge this a little bit. All right, a number of factors can get your mortgage application denied. So-called unverifiable income is one of them. Mortgage lenders want to know if you're financially capable of paying back the loan. One way they'll do this is by requesting documents like your federal income tax returns, W-2, pay stubs, or a combination of all of this. That's Freddie Mac giving us that information. Any money that you earn that is not tied to a form like a W-2 or a 1099. 1099 is, again, more like a contract worker form. That can make it difficult for a lender to verify your annual income. For instance, income you earn from a rental property, I didn't even think to mention that a while ago, may be tricky for a mortgage lender to verify. The same can be said for things like gifted cash for a down payment or a side hustle earning. Now, I'm going to talk a little bit about gifted cash for a down payment. A lot of people don't know. First of all, if you're buying a house, you don't have to put 20% down. That just gets you past mortgage insurance and things like that. And if you don't put 20% down, there's other ways to get around having to pay mortgage insurance. Reach out to me if you want to know that. But in this market right now, as a buyer, you can have a seller pay for all of your mortgage insurance and you don't have to worry about it. So that's one thing, is that down payment. But if you don't have enough, even to make like a 3% or a 5% down payment, if you've got parents or kin or, significant other or somebody else that is willing to gift you that cash, not make a loan, but just gift that cash to you, you can do that. Most of the requirements for that is it's got to get into your bank in a certain amount of time. Like you can't put it in there the week before closing because they have to go in, they have to verify where it came from. You have to write like a letter of explanation. They're going to go to the person that gave it to you. They're going to have to write a letter of explanation. Both sides are going to have to, swear across their heart, hope to die, that it's not a loan, that it's not required to be paid back. So those are things that can be done on this, but they have to go through all these extra steps to verify that gifted cash. So again, that's a thing that's outside of the norm. So it can be tricky is what this is saying. It's a more common problem than you might expect. About 12% of prospective home buyers were denied a mortgage because a lender could not verify their income, according to a 2024 profile of home buyers and sellers report by the National Association of Realtors. NAR polled 5,390 buyers who purchased a primary residence between July 2023 and June 2024. In such instances where you have different forms of income or are self-employed, it might be worth looking into non-conventional mortgage options. Melissa Cohn, Regional Vice President of William Rivas Mortgage in New York. Never heard of them, but evidently it's a New York mortgage company. So that's the other thing. And again, when you're like me, you're self-employed. If you are a small business owner, and in Dripping Springs, and all over, we all like to help our small business owners. Well, again, when you're running a small business, every dollar is important. So you try to remove as much of your income from taxable income as you possibly can. So self-employed can be tricky because you're not showing a lot of income on the bottom line. Okay, that's what they're talking about here. The good news here is that we've got programs available for people who don't qualify conventionally. A conventional loan is what you typically hear when people talk about a 20% down loan. Outside of a conventional loan, you have FHA loans, which are government loans that are underwritten by the U.S. government. So that's typically the two major ones when you're talking about home mortgages. You're talking about either a government loan, FHA, VA, USDA, something like that, or a conventional loan. Conventional qualification is what we're talking about. But here's the kicker. It is going to be a little bit more expensive. For example, you may have to sustain higher than usual mortgage rates. Okay, that's one of the things that banks like to do. Mortgage rates, and Steve talks about this all the time. Mortgage rates are based on your credit worthiness. How much do they trust that you can pay this back? If you're not showing enough of an income for them, or if your income is kind of spotty, it's a side hustle, you may make $10,000 one month, $2,000 the next month, and it just fluctuates all over the place, you're seen as a credit risk. So one of the ways they make up for that is they bump your interest rate up. Here's what you need to know. How a non-qualified mortgage works. Some home buyers who need more flexibility when applying for mortgages could benefit from non-qualified mortgage or a non-QM loan. Such loans are verify income differently. If you're self-employed, a non-QM lender can use bank statements. This is called a bank statement loan, by the way, to calculate the income that may qualify for the loan instead of a pay stub, tax return, or a W-2. Again, they're going to look at how much money you put into the bank, and they're not going to take into full account how much you actually wrote off. Okay, that's a bank statement loan. Bank statement loans used to have a pretty bad connotation back through 2006, 2007, 2008. This time they actually verify what that statement is, where your income's coming from, how repeatable is that income. For example, as a realtor, the last mortgage I got, I had to go back 3 calendar years to provide them all of my compensation for the last 3 years so they could develop a pattern for me. That's the only way that I could qualify for it. And they're going to use that to calculate the income that may qualify for the loan instead of a pay stub, tax return, or W-2. I'm going to take a quick breath here. If you've got questions, again, if you joined me late, please, when Steve's not here, I talk too fast, give me some interaction over there in the comments. If you've got a question, please ask. If you've got a better explanation for something than I have, please tell me. And if you think that I'm wrong, you can tell me that too. I just might not listen to you. So they might also look at what kind of assets you have. Other banks and lenders will accept the most recent 1099s and don't rely on tax returns if you're self-employed in a business that you own. Okay, that's a real key point there. Pretty self-explanatory. But be careful. While it may be easier to qualify through income, such loans are going to be more, it says can be, they're going to be more costly. Sales manager at Bay Equity, Redfin owned mortgage lender said. You may have to jump through more hoops in order to get those mortgages. For example, you may need a higher credit score or be required to provide a bigger down payment. Okay, again, that's something else that they can do. A lot of times you can get qualified even down to like a 580, 560 credit score. It's going to hurt your interest rate, but you can get qualified that low if you have a non-QM loan. Okay, they may require 650, 640, 660, something like that, and you're still going to pay that premium on the interest rate. Or maybe you can't get by with a 5% down payment. Maybe they say, hey, we'll give you the loan, but you got to have a 20% down payment or maybe even a 25% down payment. So again, the bank's going to try to figure out a way to hedge their bets to make sure that they're not going to be left with a bad loan. No bank wants to foreclose and have to go through the process of selling that property. Trust me, they don't want to do that. So they're going to hedge their bets to make sure that you're vested and invested and that you're going to pay that loan back. The loan may also come with a higher rate than that of a conventional loan. That's because non-QM loans do not follow the criteria of qualified mortgages set by the Consumer Financial Protection Bureau, CFPB, that came out of the 2008 financial and housing crisis. This basically was set up to protect the consumer when in actuality, and again, Steve and I talk about this quite a bit, it protects the big banks more than it protects the consumer. Case in point, you having to pay insurance on your loan to protect the bank from you. Like, no, that's not protecting the consumer. That's protecting the bank, but that's more for a different time. In the first half of 2024, the average initial 30-year interest rate for non-QM loans was 6.7 compared to 6.4 for a qualified loan, according to data from CoreLogic.com. Okay, so you're looking for a quarter to maybe a third of a point bump premium. Sorry, Steve doesn't like me to use that term. A quarter to a third of an interest rate point, so like 0.25 or 0.3 bump for a qualified loan, according to data. So that's just a premium. Just like if you're buying a piece of raw land, you're going to pay a premium of like 1 to 1.25 maybe over what that average rate is at that time. Anytime that you are dealing with something out of the box, all lenders like to deal with stuff that's in the box, nice, easy. You got a 9-to-5 job, you make $100,000 a year, you qualify for X, that's an easy loan. Once you start getting outside of that box, they're going to charge premiums for you. A stepping stone for unverified income. Non-QM loans are often better suited for those who invest in real estate or wealthy individuals with a number of assets. Guys, I'm not a wealthy individual, and QM loans are often a good option for me. So I hate that they put that in there. Investing in real estate, yes, very true. You can go and you can buy an investment property. You can buy a duplex or a fourplex or an apartment complex, and you don't have to qualify for all of that income. Again, Steve and I've talked about this a lot. You don't have to qualify on, for your income for the purchase of that property. I mean, there's not a lot of people who are going to be able to qualify for a $5-10 million property on a mortgage, but they're going to be able to use, the assets. They're going to be able to use the projected incomes from the property and stuff like that. That's what they're talking about, that it's better suited for real estate investments and things like that, and investments outside of real estate as well. In those instances, you can kind of substitute assets for an active income. Even if you suspect your income will be hard to verify, it's smart to start with traditional loan options. Guys, always, always, always contact a lender first. That's the first contact. If you're thinking about buying a house or property or doing a build or a business or some type of other real estate investment, always check with a lender first. Don't call me as your realtor first. Call Steve. Sorry, Steve's usually sitting over there. Call Steve as your lender first. That's always the first place to start. And you always want to explore the traditional options before you have to get out of that. You may have in your mind that you're not going to be able to qualify, and that's the way that you want to start the conversation, but don't do that. Talk to the professional, let them know, hey, look, I want a mortgage. This is what I want to do. Tell them I may not qualify because I have X, Y, and Z issues, but always let them see if they can qualify you traditionally first. If your application for a conventional mortgage is rejected, reach out to your lender, ask why it was denied, and then let them tell you about why it was denied. Okay, we can't verify X, Y, and Z. And then ask them, okay, are there any options for that? Okay, it could be simple. Maybe you submitted the wrong year's W-2 form. Mistakes happen. If you're going through a transition from being employed to self-employed, or you're starting a new job with a new company, a non-QM loan could be a stepping stone. A lot of times, like if somebody's transitioning, let's say, take me for example, I was in education and I transitioned into real estate. I went from a W-2 job, predictable income. I knew what I was going to make every year. There wasn't bonuses. There wasn't, major pay increases and stuff. I had a set salary, and I went to a self-employed income. Okay. If I needed to buy a house during that transition, then I can go and try to grab a non-QM loan telling them, hey, look, I'm in my first year or after my first year of real estate. I was a teacher for 12 years before that. This was my income, and I transitioned into real estate. This was my income in the first year in real estate. And they can look at that stuff and take that into account. And that's why they're calling it, potentially a stepping stone for people in that situation. Or if you're starting a completely new business, I mean, that's always a good thing as well. And so, a lot of times when you're starting a new business, you need you need trucks, you need equipment, you need stuff like that. So again, this isn't just for mortgages. This applies outside of that. Lending as a whole has these options. Once you start to show sufficient income on your returns, you can always go back and refinance that in the future. That's the key thing. If you're paying a quarter point higher, 1/4 of an interest point higher, you can always go back and refinance that later. Just like if you qualify for a loan right now with a mortgage and it's 6.5 and next year it's 5.5, well, refi out of it. You have that option. Just because you take out a non-QM loan doesn't mean you're stuck in it. Okay. So that's kind of the long and short of it, guys. There are options, and I know that there's some bad information out there, right? Some people will say, hey, if you're self-employed and you just started your business, you can't get a loan for anything. Well, maybe not. Again, it always starts with going to the people who know first. Make sure you check with your Steve, regardless of what state you're in. If you're in Texas, you call Steve Babcock. If you're outside of the state of Texas, I always recommend going to a local lender first. If you don't have a local lender in your market, if you don't know anybody, reach out to me. I've got realtors and lenders that I know all over the country. That's what happens when you network as much as I do. And when you get into coaching groups and stuff like that, you meet people that are really, really good at what they're doing. So if you need a recommendation outside of the state of Texas, let me know. That's part of what I do. I'm not seeing any comments here. You guys are just letting me talk. And that's okay. Hopefully this wasn't a completely dry subject, but I'm going to switch up on you just a little bit. I just posted a Facebook reel today. I think they're reels, maybe they're stories. I don't know what they are. It's the one at the top. I posted one today where I was talking about just kind of an on-the-spot market update in Dripping Springs, Texas, and Austin, Texas. What's today? December 16th, 2024. I'm going to talk a little bit about that. Anecdotally, that's not data behind this. This is what I'm seeing with my eyes and when I'm talking to people and stuff like that. Anecdotally, buyers came back or started to come back into the market after the election. I was a firm believer in it, and I read way too many studies because I'm a data guy, right? I read way too many studies that talked about how it doesn't matter who wins the election. After the election and the following year, the real estate market is going to rebound. It's happened like all but 2 times in the history of ever in the United States. So the election's gone. Buyers are starting to come back in. And I'm seeing it on the ground. My listings are getting more showings. I've got more buyers calling me. I've got more investors calling me. And right now, it hasn't quite made it to the point where it's starting to show up in a lot of new pendings. Again, a little bit of an aside, new home builders up in the Taylor and Hutto area. I talked to a couple of them. I got a client that just went under contract up there. This particular one in Taylor ISD, close to the Samsung factory, had 16 new contracts in November, had 17 contracts in October, which it's a little bit, October was before the election, but still 17 in October. And before that, the highest they had in any month since April, I think he told me, April, was 5. So if you look between May and September, the highest number of contracts they had was 5, and then it went 17 and 16. That's a massive difference, guys. Buyers are back. If you're a buyer, we still have a seller's market, especially in Dripping Springs and markets like this. If this is where you're looking to go, pretty damn good time to look at starting to do something at the beginning of this next year. I've been telling my sellers, I feel like, and this is the same thing that happened the last 2 years, about the middle of January, the market kind of took off in Dripping Springs and in Southwest Austin. Those are the 2 markets I'm most active in. The market started to take off about mid-January, and it ramped up through February and got into April. And then in April of both years, we had a correction in interest rates, and interest rates went up, which shut the market off. So if you are a seller, I think your target is the beginning of this year. If interest rates continue to, or if interest rates continue to stay stable or drop, it's going to be shifting back towards a seller's market. So if you're a buyer, I would try to do something, it's going to be shifting back towards a buyer's market because we're going to be getting rid of inventory. If you're a buyer, I might look to try to do something in the first quarter as well. Or, kind of before the end of the school year, because usually May starts really when that buyer season, when the buyers really start to come out of the woodwork. But anyway, we haven't seen it happen quite yet on resale homes. The pendings are starting, contracts are starting on new homes, new construction, at least up in that northeast quadrant of Austin. So if this is something that you're thinking about doing, I'm not saying the market's going to explode. It's definitely not going to do what it did in 2020 and 2021. That's not going to happen, thank God. But we're going to start seeing that acceleration again as we get into next year. I firmly believe this. Take that and $5, you can go buy you a Starbucks coffee. But one person's opinion, that's what I'm doing here. So, guys, if there are no comments, no questions on any of that, I'm going to let you go for the night. Nice short show tonight. If you do want to look at buying or selling something this year, give me a call, or if you already have a trusted realtor, reach out to them, guys. Do business with professionals. If you have a professional in your life, go to them, stick with them like glue. They're going to take care of you. That's the whole point of being a professional, is to take care of the people who are taking care of you. I know your realtors are going to do that. If you don't have that person in your life, reach out to me. Even if you're outside of the state of Texas, I will connect you with somebody who will do that. And if you're looking for a lender, like I said, Steve is the guy. And again, outside of the state of Texas, I've got ones I can connect you with. All right. We're getting close to Christmas, guys. I will see you next Monday for one last show before we go ho, ho, ho. I didn't mean to make it rhyme. Cheers.